Hello and welcome to the Harwood Report for May 29th, 2018. I am Keith Harwood, the host of the Harwood Report and the founder of Trade Academy. As a reminder, all services and content are provided for educational and information purposes only and are not intended as legal or financial advice. Consult with a financial professional before executing any trades. I'm going to talk through everything I normally talk through here, folks. Just looking at the equity indices, obviously we're having a little bit of a rocky day today. Along the equities and bonds are very firm. Not a lot happening in the precious metals market, and oil had a very interesting pullback over the last couple of days with OPEC comments. So there's a lot going on here, and so let's get into it. First things first, fear and greed is now at a fear level. That was updated today about 20 minutes ago, and you can see where it's coming from. The S&P has fallen below its 125-day moving average, so that thing that's been stuck at extreme fear is still there. But we've also had some hedging coming in. It looks like a lot of people buying some puts over the last couple of days, getting back into the February-March MO on that initial dip in the market that started last week. Bonds being so firm and stocks being weak has pulled this down from greed. So those things that I was seeing last week that were all showing, sort of bullish indications, with the only thing lagging being market momentum, have all been pulled down to sort of start to catch up to the market momentum, where we're not seeing that go to extreme highs. That's a little bit of a surprise, frankly. And we'll just have to see how this comes through. And it's all based upon this new fundamental input of what's going on in Italy. People are worried that this Italian political system may do serious damage to the European Union. And in doing so, they've decided to de-risk their portfolios. Puts demand into bonds, demand out of stocks, and now we have to wait and see how the next reaction goes, because this election's 6 months away. So are we really going to do this whole de-risking for 6 months, or is it going to be forgotten like many of the other things have, and then, brought back to the forefront in 5-ish months? First things first, the technical stuff going on with the S&P. So this is a breakdown from below, it's below the 100-day moving average now. That had been providing support. We were generally trying to create some consolidation there. I expected this to create this consolidation for a launch higher. Instead, this weekend news has created a breakdown. We're not at a place that I think we sit. So this market has effectively two choices here, because we're kind of in no man's land here. We either retest that 200-day moving average that everybody's been talking about so much, so we got five-ish dollars of downside, or we return to the previous area, $4 or $5 higher from here. So if my thesis at this point is we're not going to sit, we're going to move up or down $5, well, that's not too bad of a trade for a straddle. Vol is up a little bit. So, I don't want to necessarily get overly aggressive in a vol perspective, but it seems like gamma should work right now. And vol's not even that crazy high. It's just kind of in the middle of this March range. We're not dealing with February by any means. And of course, to get to those February levels, I would expect to see us break down much harder, make a new low here, press down towards the 200-day moving average. That doesn't necessarily look 100% imminent yet. It's a little bit unclear to me whether the next direction's up or down. We've got everything coming in overnight news. It's hard to chase into it in the morning if the market move's already happened. But what I can do is I can look at something like even out the Monday. It's not expensive to get into a 268.5 straddle for Monday for $4. That gives me a lot of way to play this. If the market recovers today's move, which was over $4, then that thing is worth $4 or more. If it happened all tomorrow, I would look at this and expect it to be worth closer to $6. And if the market collapses, this should increase in value pretty drastically as well. So I think that's the way I look at this right now, is looking at the 268.5 straddle here for 402. It isn't overpriced. We've got the end of the month that should create some money flow issues. We've got all this European stuff coming up. I mean, that's a way to play this. It's just that the move should continue. And sorry, as I look at this, at the price point, it's $3.92, so it's actually a little under $4. So $3.92 is a very cheap price for a straddle that's got this much movement potential in it right now, especially with what we're seeing today. So that's that first idea, is just looking at that as a pure straddle type play. If I go to some of the others here, I think that IWM is important to look at here because it's holding up so well, and it makes sense that it would hold up well, right? I mean, these are generally domestic companies that don't have as much international exposure, so problems in Europe don't have as big of an impact. We're still holding above the January highs in IWM. So if the market does recover, IWM probably just goes back to its highs there, up $2.50. And if the market continues to collapse, IWM has massive downside. Because at some point, people just sell everything, give up. It's not because IWM is particularly bearish off of this news. It's just that people need to de-risk at that point. And they're clearly long small caps given the move. You're starting to see some rollover signals here in the MACD. But I think that the play here is that we're looking for either a small rally or a really big pullback, down here towards 155. Vol and IWM is cheap. I'll explain a little bit more about how I'm looking for the trade there, given that setup, in the premium newsletter that'll be going out after the video. And come back to that. I mean, you guys can get 2 weeks for free on the premium newsletter if you're interested. The Qs are just chopping in the range. So the Qs aren't collapsing either. So we've got a couple of things that are going on here. We know that the S&Ps are very weak. We see the industrials being very weak. But tech, the big leader from last year, is still okay, and small caps are still really strong. They haven't liquidated. The VIX is up a little bit, but if that kind of move happens in the VIX and it gets any follow through, I got to see that. I would expect to see some serious liquidation potential there in tech as well, because that does have international exposure. That maybe is more focused on the China story that's not seeming too bad right now. But if anything goes bad there, then I've got problems in Europe and problems in China, on top of all the problems right now in South America. I mean, we look at Brazil. Look what Brazil's doing right now. It's just falling out of bed. So we've got problems in multiple continents right now. And I'm a little nervous that something bad could happen in China and destroy tech and pull that back down big as well. So I'll talk a little bit again about how I'm looking to approach that, given the market setup right now. In the newsletter, but I want to bring you guys over to the gold story, because I think that's something that's interesting, that there's maybe a more immediate trade here. Dollar yen's very weak and just falling because risk off. Risk off tends to be buy the yen, sell the dollar, and that correlation is very strong to gold. So when dollar yen was here before, gold was up $1 higher. We got a little bit of a pump up on the 24th, but we've really been sitting in gold in spite of this weakness in the dollar-yen relationship. When we look at DXY, obviously the dollar overall is strong. It's just dollar-yen that is particularly weak. I think that there's going to have to be some follow-through in the gold here, because either the market recovers or dollar-yen completely falls out of bed and people look for a hedge, and that hedge has been bonds. We saw here. Let me just look at this move in bonds. Or it goes towards gold. And remember, bonds are telling us that there are fewer interest rate hikes coming because of the problems in Europe, maybe. And so that should be a bullish input to gold as well. So I like the setup here in gold. Vol's clearly up quite a bit today, up over 10% now. Let's get this vol chart up here. There we go. So we can see that the vol is kind of near the highs here in gold. So maybe people are hedging by buying gold calls as opposed to buying gold. If I look at silver, silver vol is also, sort of on the high end of the range with this move today. This is loading slow, and I apologize for that. So let's just skip the silver thing and go straight to the trade that makes the most sense to me, and that's GDXJ. So while this is loading, I will pull up the chart in GDXJ to show you guys what I'm looking at here. So GDXJ. It's testing the low end. Part of this is because there is an equity component to GDXJ. Obviously, it is the gold miners. But if I think that gold's going to spike either way with weakness in dollar yen, there's a decent chance then that the miners, which make money by being long gold and also mining more of it, should spike too. So this is testing the low end of the range. There's going to be some resistance here on the way towards 34, but we could see that explode if dollar yen continues to weaken here. And with vol and GDXJ where it is, 21 was ridiculously low. 22 is ridiculously low. 23 is ridiculously low. Anything under about 25 is ridiculously low. So where do I go? Well, I mean, I can play this very short term, knowing that if the market bounces back, this is a way to define my risk to a small amount of money. I can just look at next week's 33 and a half for 20 cents. If the market collapses or not, but dollar yen continues to weaken and bonds continue to firm and money flow goes into gold and money flow goes into the miners, this could spike. Could easily be 34 by the end of this week, and it could be, 35 or 36 if it takes out that 34, whatever this is, 34 and a quarter-ish, 34.26 there, 34, 36, 34, 34. If those levels start getting taken out, we're looking at 35 plus for GDXJ, and that puts those calls worth at least $1.50 if we go to 35. All right. I wanted to come back to TLT because obviously this is a big move and it's having a big impact on financials, which should be negative for IWM, but it's not because IWM's got enough other stuff going for it right now to stay where it is. We're back at the highs of this range. One of the reasons that IWM is spiking, among many, is that people have been selling a lot of bonds under the expectation that rate hikes are coming, and that's bad for bonds. That higher yields is negative for bonds, right? So we have this massive spike now as people get out of those shorts. I am inclined to say that TLT may fade from this move. Maybe not all the way back down to 117, but I don't see it taking off from here because it seems like everybody kind of panicked today on the bond story. Again, I'll talk through the options trade for the fade move because a fade move I need to play differently than a breakout type move. They have different types of setups. So that requires different types of option strategies to them. It's not a straddle or a strangle necessarily. It's not a call or a put like I'm seeing in GDXJ. Let me move over to oil. So look at oil here and see the break. So OPEC started talking about maybe lifting some of their curbs, and that put a little bit of negativity to oil. On top of it, Euro has a correlation to oil there, and that's finally having an impact on oil as well, this weakness in Euro. So all this stuff is really hurting oil here. And, at the end of the day, I got to think that oil has a little more downside if this European issue doesn't get resolved, if it doesn't get bought up. So one of the things I can say is if I'm thinking about any sort of bullish strategies in equities, maybe a reasonable hedge would be something short in the oil sector. When I look at XLE, it's washed back out to the May levels. But where's USO? It's down there at the April levels, and it got through that May chop level. So XLE's had a decent move, but maybe there's more downside there. Maybe down to 70. OIH has looked like it was ready to just take off, and it's in the same sort of ballpark. And when people have been getting rid of oil names, they've hit OIH harder usually. So they haven't hit OIH as hard this time as they have in the past. And that makes me think that maybe OIH is going to get that liquidation move back down to 24.5 here. Even though oil is still higher than it was, 2 months ago, if people have to get rid of oil names, they're going to hit OIH first. You can see that they're even already putting a lot of this into some of the vol here. It's up to 31% now. Traditionally, vol here is at a range of about 26 all the way up to about 35, so it's kind of near the high end of the range. So how do I play for a move back down towards that consolidation area around 24.5? Well, with where vol is, I don't mind doing this as a butterfly. What I do in that case is I buy a 26 call, I sell two 24.5 put, or sorry, 26 put, sell two 24.5 puts, and then I buy a 23 put. So what this does is for a price of 18 cents, gets me exposure to a move down to 24.5 with vol here or maybe even lower. Maybe vol comes off. 35 is pretty high vol. So if vol goes to 35, we're at the high end of the range. I don't mind if I'm flat or short there, or if I'm short a little bit of vol there. As it stands, I'm flat Vega, so I'm not trading Vega here. I'm just trading a very light delta for a move down to that 24.5 level. And see, remember where 24.5 is, right in the middle of that consolidation area. This is a very low risk way for me to play that drawdown, that pull back in oil. Okay, so that's kind of how I'm thinking about playing the oil story for now. Now again, if oil firms and I start to see USO and the euro firming again, then this is back to thinking about the breakout in OIH. So there's some volatility to the upside that cannot be forgotten. But for now, I think the fear trade, the trade that has to be considered is that potential for a full washout back down to the lows. And again, if USO can reclaim, say 14, so when we're looking at crude futures, you know, if it can get back above sort of 68, 69 level and make 70 basically the pricing again, then I think that we're talking about that that potential for USO and OIH and XLE to all spike together. All right, that's it for today. So reminder, I'm just, looking at bigger moves in SPY. I think that, the market wants IWM to just kind of grind higher and the Qs to grind higher. But if that liquidation happens in SPY, it's going to have to flow through to everything. Bonds, just a big move today off of, I think, partially liquidation of positioning as the position goes against them. Gold, I like to the upside. In particular, I kind of like it with the GDXJ stuff, given where volatility is. Even though GLD may lead that move, GDXJ has the leverage. And in oil, I think I want to look for something cheap to the downside just because I think that my gut tells me that all of this kind of gets bought up and everything recovers, but I want to look at something in OIH to play for that downside in case it just keeps going. And so that's why I was looking at that butterfly. The Harwood Report also has a newsletter that I'll be putting out shortly. That includes more setups. So I talk a little bit more through what I'm looking at in IWM and the Qs and give you the specific ideas of how I'm looking to approach those markets. On top of it, I've got all the other ideas, and I give a midweek update as well. It's $49 a month normally, and you can get the first 2 weeks for free. So if you don't like it after 2 weeks, cancel. If you do like it, stay on for pretty cheap. So I urge you all to give it a shot. TradeAcademy.co/Harwood Report to sign up. You can always email me, Keith, at TradeAcademy.co, or call me 312-600-8004 with questions. Thanks, folks, and good luck trading these a little bit more volatile markets.